Hey, what's up guys? Florida Mortgage Gal here. I just did another video talking about the updates on FHA and mortgage insurance and the extra affordability because of all of it. Now I wanted to do a kind of a part 2 to all of that and get into the different types of mortgage insurance. Without further ado, let's get started. All right, so before we get into the different types, what is mortgage insurance? Well, it's pretty simple actually. It doesn't protect you, the buyer. It's not part of your home insurance. It actually protects the mortgage company. Back in the last housing crisis and the last housing crash, 2007-8-ish, you had a lot of buyers defaulting on their loans, and therefore it was causing the banks to lose a lot of the income. They were dealing with all these foreclosures on their hands. They didn't have enough money to run their banks, and then the banks would default as well. Obviously, this causes a huge chain reaction throughout the entire economy, and it's something that the US government is invested, or at least has a vested interest in making sure that that doesn't happen again. What did they do? Well, they created federally standardized loans, and there's different types of loans out there where you have HUD loans where they're true government loans. You have FHA, USDA, and VA under that umbrella. And then you have the Fannie and Freddie loans, or Fannie Mae, Freddie Mac loans. That's your conventional loan. They are insured a little bit differently, and there's technicalities that, Fannie and Freddie aren't true government loans, but outside of the semantics of all of that, when you're dealing with any of these loans, the banks are taking on the risk that you, as the buyer, are going to foreclose on the property, or that's a possibility that you could foreclose on the property, especially when you're putting less and less money down. There needs to be some sort of balance, right? Where people are able to go into a loan as a low down payment option, find something that's affordable for their family. If you have a $400,000 purchase price, $12,000, 3% of that's still a lot of money to come up with. And then plus your closing costs, which could be another $12,000 on that easily. You can't just mandate that everyone's going to put 20% down on a home, because if you do, there's not many Americans that are going to be able to afford a primary residence. What the government did is they said, okay, we're going to standardize these loans in a couple different ways. We're going to say this is how you have to calculate the income. We're going to give you an equation to make sure that these people are more likely to be able to secure this payment or be able to afford this payment over the course of the next 30 years of this loan. So there's different rules that us as lenders have to follow in order to calculate their income. However, it's still high risk to the lenders because it's a low down payment, especially when you're looking at things like VA loans where it's 0% down, or FHA goes down to 3.5%, conventional goes down to 3%. These are people that don't have experience with home ownership a lot of the time, so they might not know how to budget accordingly. That being said, there's mortgage insurance. Now, it looks different on the different loan types, but it basically insures the bank and says, so it goes ahead and insures the bank, and more accurately, the lender, whoever is going to be funding this loan and holding it over the life of the loan. So that money actually goes to your mortgage lender as a type of insurance to them in order for them to write the loan for you at the lower percentage down. You pay your home insurance, they can still give you a low great rate, they can give you the loan at low money down, everyone's happy. They're insured with that extra incentive of the mortgage insurance. Now that that's established, let's just talk about the two main loan types. I'll probably do a whole nother video on just USDA loans so we can go top to bottom on that. What you do need to know on that, or what you can know on that from now, is that USDA loans are going to have less mortgage insurance than FHA loans. But the two main loan types, FHA and conventional, let's get into those first. Conventional mortgage insurance is pretty simple. We'll do that one first because it's a little bit more simple. That one's going to be affected by things like your credit score, your loan to value, your qualifications as a home buyer, which is part of the reason why it really makes sense to do conventional loans typically if you're above a 700 credit score, if you're in the better credit score range. There are different programs out there that make mortgage insurance a little bit cheaper. There's Home Ready and Home Possible, which are programs between Fannie Mae and Freddie Mac. They're income capped, and they do allow you to have less mortgage insurance. And what they mean by that is that you haven't owned a home in the last 3 years as your primary residence. That can be an option too, to have less mortgage insurance, putting money down at the different mile markers. If you go from 3% to 5, 10, 15, 20, sometimes 18 or 17, 18 in there is a little bit. And then obviously once you're at the 20% down, there's no mortgage insurance anymore on that loan. You can have your mortgage insurance fall off a couple of different ways. You can reach out to your servicer, whoever's holding your loan right now, whoever you're making your monthly payments to. If your home's appreciated a bunch, if you paid extra towards principal, if you think you're approaching that 20% equity point, always call up your servicer or poke around online on your online portal. See if there's a way that you can appeal and have that knocked off early. You don't always have to refinance off that mortgage insurance. So let me say that again, because it's a big misconception. You don't have to wait until you hit the 20% of the purchase purchase price or until you refinance in order to knock off that mortgage insurance. Oftentimes you can get it to fall off earlier if you're proactive about it. Let's get into FHA because it's a little bit more complicated. And I touch on this in another video, but in FHA there's two types of mortgage insurance. And unless you're putting more money down, like going into an FHA loan at 10% down, that mortgage insurance is never going to fall off. And also you won't be able to call your servicer and have them knock it off earlier, at least I've never heard of that happening. That being said, you have the 1.75% of the loan amount that's added back into the loan. So if you have a $100,000 loan, there's going to be an extra $1,750 added back into your loan that you have to pay off and that you're paying interest on over the life of your loan. Now, you also have a monthly mortgage insurance. That monthly mortgage insurance is going to be a certain percentage. Right now, it's decreased by 30 basis points or 0.3%. So it's a little bit cheaper and definitely a much more affordable option than it used to be. That mortgage insurance is not going to be influenced by your credit score, which makes FHA loans typically a little bit better loan type for people with lower credit because they don't have that penalty hitting them on the mortgage insurance. Let's touch briefly on VA loans as well. VA loans don't have mortgage insurance, but they do have something called a funding fee. So that funding fee is rolled back into the loan. It's kind of like how you had that 1.75% inside of the FHA, that lump sum that's added back into the loan. That's how it works out on the VA loans. That's how the funding fee works. So you don't have the monthly mortgage insurance in VA loans, but you do have that one lump sum that's added back into the loan amount. And that amount will change, that percentage amount will change based off of how much disability you've been awarded by the VA, what your percentage down is, and if you've used a VA loan in the past. Talk to your lender and see which bracket you qualify for. If you have been awarded disability by the VA, you are exempt from the funding fee, and there's actually other perks from that as well, but that's a whole nother video. So hopefully this helped explaining mortgage insurance. Have a great day. Bye.